This is going to be the most important video that you guys, the viewer, watch as it relates to our current economic situation, not only in the United States, but globally, and where we are headed over the next couple of quarters here. We're going to be talking a little bit about some of these developments with China, which are incredibly important to these new negotiations that could pop up over the next week or so here. But there is a very, very important economic dilemma that has been talked about in the past, but nobody is talking about this right now. And I am quite honestly shocked that not everybody is screaming about this very, very important economic dilemma that is coming to a head right now. So we're going to be breaking this down, going through everything, making it very simple for the viewer to understand. So again, if you guys do enjoy the information and analysis I provide for you guys in these videos here, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot in spreading these videos out to as many people who want to learn. And specifically for this one, make sure that you guys are sharing this video with a friend, with all the groups that you are in, because again, I wish more people knew about this information here. It would make it a lot easier to understand exactly what is going on in the present. And again, as always, if you guys want to see more videos like this, make sure that you guys are subscribed. But let's get into this here because something very, very important happened today that I don't think a lot of people quite caught. So again, what just happened at 10:10 a.m. Eastern time, rumors emerged that the White House was considering a 90-day tariff pause. At 10:15 a.m. Eastern time, CNBC reported that Trump is considering a 90-day pause on tariffs for all countries except China. A couple minutes later, the S&P 500 had added over $3 trillion in market cap from its low. We can kind of take a look at this move here on the 5-minute time frame. This was a 3.88% move in a matter of minutes here. And the fact that the market made this move so aggressively is so incredibly important to how investors as a whole are viewing this market. But we're going to talk about that a little bit more in a second here. Then reports emerged that the White House was unaware of this pause. The CNBC reports that the headlines were incorrect, and the White House officially came out and said that the tariff pause headlines were fake news. So a lot of volatility today, guys. And also the fact that we ended up seeing this market rocket so aggressively off of this 90-day pause tariff news, all that is going to do in the present is embolden this current administration to keep going because they know they have a bailout switch if things go too far. Right now, they are looking at everything and saying, okay, the market just now reacted to this news so positively that if it was true, would have probably continued that movement to the upside there. But as soon as that news came out that it was not true, immediately reversed to the downside. Now, again, that's just kind of a theory. We're kind of speculating there. But we also have to take a look at what ended up happening throughout the day here in order for us to kind of confirm everything that I just said. So, basically 30, 45 minutes later, Trump comes out and says additional 50% China tariffs effective on April 9th if China does not withdraw its 34% tariffs by April 8th. This is incredibly aggressive and wildly escalatory and would really, really cause even more pain in the markets here if this were to go through. Now, it's not necessarily these tariffs themselves right now as it relates to China and the US that are the important part because there is a lot of negotiation going on back and forth. But if China just kind of says, I'm going to throw in the towel, I'm tired of this, there is something very, very, I'll say it right now, awful and catastrophic that they can do that nobody is talking about right now. And it has to do with intellectual property rights. Let's roll this clip right here and explain this a little.
I think about a lot is China had the state council meeting a couple days ago. And in that state council meeting, they announced a series of measures and a series of steps that they would be willing to take on IP infringement in the case of retaliatory tariff escalation in a trade war. What that means is that China may step up and say, you know what, we are disregarding all of the IP rights held by IP rights holders around the world, and they could steal IP more openly, more brazenly. And because they have a lower cost of manufacturing, they have a larger manufacturing base, a lower cost of power, they could basically take the only thing that much of American enterprise relies on, which is our IP rights, and say, we're just going to, well, people might say, oh, they already do that. They already do that. They do it to an extent. But imagine if China just made copies of Microsoft Word and started selling it around the world for $5.
Yeah, I mean, they did that internally for some period of time. Then they started to respect it internally, but they've never done it. Great point.
And
by
then imagine,
shipping Disney films overseas.
That's right.
Yeah.
And so now imagine if they started taking all of American manufacturing drawings, blueprints, designs, and they have all this manufacturing capacity, and they sold everything at 10 cents on the dollar to all of the global markets that the U.S. is now cutting trade ties with because of the tariff escalation. And China says, we don't care about your IP rights anymore. We don't care because you've cut us off. The rest of the world needs someone that will sell to them.
So if you think about the implications of a situation of that large of a scale playing out, where China is going to come in and basically start stealing and taking a lot of the intellectual property of the United States and selling it for pennies on the dollar abroad, think about the effect of DeepSeek being released a couple of months ago and what that did to US markets for a couple of days there. Now apply that on everything and what that type of effect would be, not only on the market, but just the American economy as a whole. It would be catastrophic. And again, when you think about the situation here between China and the United States and this potential for an art of the deal situation and a lot of these tariffs being used as bargaining chips, well, in this case, China looks like it has the upper hand. But again, if you look at China's debt to GDP, their plans to add more stimulus, and what would happen with their currency if they were to continue to go down this route of stimulus, well, their economy would start to slip even more. So again, there is balance on both sides. Hopefully they are able to come to an agreement before this happens. But this is a real risk in the system right now that nobody is talking about. Now, I want to talk a little bit about some of Ray Dalio's comments on the market, the system, global markets as a whole here, because that is going to feed us right into the most important economic concept that literally nobody, I think but myself, is talking about right now as it relates to the broad global economy. So this was an article posted on Ray Dalio's Twitter today. The monetary and economic order is breaking down because there is too much existing debt. The rates of adding to it are too fast, and existing capital markets and economies are supported by this unsustainably large debt. The debt is unsustainable because of the large imbalance between A, debtor borrowers who owe too much debt and are taking on too much debt because they are hooked on debt to finance their excesses, example, the United States, and B, lender creditors like China who already hold too much debt and are hooked on selling their goods to borrower debtors like the United States to sustain their economies. There are big pressures for these imbalances to be corrected one way or another, and doing so will change the monetary order in major ways. For example, it is obviously incongruous to have both large trade imbalances and large capital imbalances in a deglobalizing world in which the major players can't trust that the other major players won't cut them off from the items they need. So when you think about this, there's a massive conflict here in this ever-increasing amounts of debt and the ever-increasing need for China to continue selling a lot of their goods and services to the United States. Now, Donald Trump and the Trump administration have now recently come out and started talking a lot about this trade deficit, and they're really trying to balance the budget here, which quite honestly, at this point, at where we are in the system with as much debt that we have right now, could quite honestly be disastrous, and I'm going to explain to you guys why in a second here, but it really has to do with the fact that when you are the global reserve currency, there are certain things you have to do in order to keep the system going, but you have to do it at a moderate pace. If you push it too far, bad things happen. If you reel it back in too much, even worse things happen. So when we come over here to this Twitter thread that I posted yesterday, what we are going to be talking about here is Triffin's dilemma. This was coined by economist Robert Triffin. This is the most important thing happening right now in global markets that nobody is talking about. So we have a little history on Robert there, but the issue was named Triffin's dilemma and revolves around the fundamental conflict for countries whose currency serves as the global reserve currency. In order to meet the global demand for liquidity necessary for international trade and reserves, the reserve currency must supply its currency abroad by running balance of payments deficits. Just think about it like this. If you have all of these different countries around the world, and one of them is the global reserve currency in which all of the other countries have to transact in, how are they then going to get enough of those, in this example, dollars, in order to facilitate all of the trade that they need between all of those other countries and also have a sufficient amount of reserves in their banking system? Well, we, let's say the United States, has to provide those dollars abroad by running these deficits. There needs to be more dollars going abroad in every single year in order to maintain global liquidity levels and stimulate global economic growth. The problem here is that as these deficits continuously increase, this erodes confidence in the reserve currency's value as they exceed the country's ability to pay their debts back. Now, previously to the closing of the gold window, what people were looking at was the amount of gold that the United States had in its reserves and all of effectively the claims, the dollar claims that all of these other countries had abroad. This is why the gold window closed, because the United States did not have enough gold to be able to pay back all of its debts. The problem now, though, is that currency in these days is not backed by gold. It's backed by trust. And the trust is effectively that the United States will have a buyer for its debt, or people around the world, organizations, corporations, governments that will continue lending it money here. And that's a big problem, because as we see today, let me come over here, 10-year yields and overall treasury yields are starting to move back to the upside again, making borrowing costs even more expensive. So you can see here this relationship. As you do what you need to do as the global reserve currency, you continue to go into debt, run these balance of trade deficits. Countries will be even more or will deem you even more risky, because you have to continuously go into more and more debt to do this. So the solution to the problem is also the problem here, and that is the dilemma. But moving back over here, on the other hand, and this is what we're dealing with now, if a reserve country decides to prioritize domestic stability by reducing deficits, which is the goal of these Trump tariffs here, it restricts global liquidity because less dollars will be spent on foreign imports, and there's going to be a lower supply of dollars abroad, potentially limiting trade and economic growth. Now, just to make this very simple for everybody, you may not like it, but this is the way that the current global economic system is set up. If you want to maintain your status as the global reserve currency, you have to run trade deficits every single year. Now, to the extent that you run trade deficits matters, because again, as we said before, if our debt levels, which they have, get completely out of control, your interest payments skyrocket, your credit rating goes down as a country, people view your nation as a lot more risky, while interest rates go up, but you still have to continuously issue more and more debt, so you enter into this giant debt spiral. And this is exactly what the Trump administration is trying to stop before it gets out of hand. The problem is, though, is that when you think about exactly what the Trump administration kind of outlined for us last week, that these new tariff rates were almost solely based on the level of the trade deficit that we have with each individual country. Well, as we've said in this video here, if you really push that the other way, and if they were to completely accomplish a balanced budget here, well, you would significantly limit global liquidity and global economic growth. So the analogy that I've used a lot with my private community on all the private live streams that I do for you guys, whether it be VIX Insights or Less Trades, More Profits, is if you think about the two different paths that we could have gone on with the two potential administrations that we would have had, a Kamala Harris administration or a Donald Trump administration. With a Harris administration, imagine you are stuck in a car and you are moving at a very fast pace towards an immovable object. You can't get out of the car. You don't know how far away this immovable object is, though. With a Harris administration, with the continuous amounts of even more debt and keeping the status quo in place, well, as we all know, interest rates are higher. We continuously have to refinance debt at the short end of the curve at even higher interest rates. What you are doing in that sense is you're speeding up the car. Now, you may not hit that immovable object in that administration, but you are going to get closer to it. Now, with the Trump administration, with what we're seeing here and what their outlined goals are in that same example, is you're able to put the brakes on that car a little bit. Now, you still might hit that immovable object, but the odds that you do are lower because you've slowed down the speed of that car moving towards that immovable object. But we know that this is exactly what the goals are for this administration, and to basically reorder and reorganize the current global economic system. Scott Bessent sees a global economic reordering, and he wants to be part of it. When we move down a little bit further here, again, in his first interview Where is this right here? Enacting tariffs and cutting spending will also be a focus, he said, as well maintaining the status of the dollar as the world's reserve currency. Now, remember, these two ideas here, this tariffs generating revenue, balancing the budget, and maintaining the status of the dollar as the world reserve currency is technically a competing belief. Because if you push these tariffs too far, again, you limit global liquidity, you lose faith in the dollar, people won't want to transact in dollars, and they will find a different way to conduct their business there if they lose faith in the United States. But this can happen on both sides. You can lose faith in the United States from being able to pay off its debts, and you can also lose faith in the United States being able to supply a lot of these dollars abroad. So they really have to do here is thread the needle. They have to be able to slow things down, shrink these deficits a little bit. But if the goal is to actually balance the budget here, I would say that that is a pretty bad goal to have, because we know what would happen to the global economy. Again, lessening liquidity and slowing down global economic growth significantly. And this is why I've said many times in the past and in this video here that this dilemma that exists in global markets today is so incredibly important, and I don't know why more people aren't talking about this, because this is exactly what this current administration is trying to navigate. They are trying to thread the needle in Triffin's dilemma here. Will they be able to do it? I don't know, but in this case right now, as of today, as I said before in this video, the Trump administration is even more emboldened to continue to kind of raise the stakes here and increase the levels of these tariffs here, especially as it relates to China, because they know what's going to happen if they start to walk some of these statements back here. Markets will bounce to the upside. There is a lot of cash sitting on the sidelines ready to come into the back into this market here if this uncertainty and volatility is going to go away. So, guys, that is going to wrap up this video here. If you guys did enjoy the information and analysis I provided for you guys here, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot in spreading these videos out to as many people who actually want to learn. And again, make sure you share this in all the groups that you're in with a friend so that they can be more educated on the market every single day. And again, if you guys want to see more videos like this, make sure you hit that subscribe button. But until next time, guys, I will see you. Peace.